Hey, how's it going? In today's video, I'm going to be talking about revenue and what that is. Revenue refers to total income generated by business or organization from its primary activities, such as selling goods or services. It represents the money earned by the company before deducting expenses, taxes, or other costs. Revenue is a crucial financial metric as it indicates the top-line performance of the business and its ability to generate income from its core operations. There are different types of revenue, including, but not limited to, sales revenue. This is revenue generated from sales of products or services to customers. It is the most common form of revenue for business to engage in selling of goods or services. Subscription revenue. Some business, especially in software and media industries, generate revenue throughout subscription-based models where a customer pay a recurring fee for access to a product or services. Advertising revenue. Media companies, websites, and social media platforms often generate revenue throughout advertising, where advertisers pay to display their ads to the platform audience. Rental revenue. Companies that own and lease out property or equipment, such as real estate or property companies, and equipment rental businesses generate revenue from rental fees. License revenue. Businesses that own intellectual property like patents, trademarks, or copyright can generate revenue by licensing the use of the intellectual property to others. Interest and dividend income. Financial institutions and investors can generate revenue throughout interest earned on loans and investments throughout dividends paid on stock and other investments. Royalty revenue. Authors, musicians, and creators can earn revenue throughout royalty payments when their work is sold or used. It's important to note while the revenue represents the total income generated, it does not reflect the profitability of the business. To determine profitability, you need to subtract all the expenses, including operation costs, taxes, and interest, from the total revenue to calculate the net income or profit. Revenue is a critical metric for assessing a company's top-line performance and growth potential, but it is most to be considered in conjunction with other financial metrics to get a complete picture of the company's financial health. Why understanding revenue is so critical for your business. Financial performance assessment. Revenue is a key indicator of the company's financial health and performance. It provides insights into the top line growth of your business. Analyzing revenue trends over time allows stakeholders to assess where the company is growing, stagnating, or declining. Profitability analysis. While revenue is important, it's not the same as profit. By understanding revenues in conjunction with expenses, business can determine where profitability without revenue, where is to potential for profit. Analyzing both revenue and expenses helps identify areas where a company can improve its profitability. Budgeting and planning. Revenue projections are essential for creating budgets and financial plans. Business needs to estimate their expected revenues to set realistic goals, allocate resources effectively, and plan for future growth. Accurate revenue forecasts are crucial for making informed strategic decisions. Valuation. When business are both or sold, revenue is a fundamental factor in determining the company's value. It's often used in valuation multiples such as price to sales ratio. Understanding revenue is crucial for negotiation of a fair price during merger and acquisition. Taxation. Revenue is a key factor in determining tax liabilities. Its impact the amount of income tax a business must pay, as well as other taxes such as sales tax, which is often based on revenue. Strategic decision making. Revenue date plays a pivotal role in shaping a company's strategic decisions. It can influence decisions related to pricing strategies, market expansions, product development, and investment in sales and marketing efforts. While I'm trying to talk about revenue, there are a lot of people fighting bosses downstairs on PlayStation, which is very interesting. I guess. Overall, the finance can be such a boring topic for anyone, but either way, I like to share my journal for everyone who is interested. I have published a journal. You can find it on my company's website if you would follow the link below. Overall, in the journal, I'm sharing the key areas that everyone should focus across the day. That would be overall finance, improving your dictionary understanding when it comes to finance, as well as key areas would be with hydration, personal, professional lives, improvement, perhaps the 3 areas that you should focus every single day. That would be just some of the areas, some of the values that you should at least understand a little bit better and structure your day. For everyone who is interested, you can follow the link and purchase this journal. Are they shouting? They're definitely shouting upstairs. There's some battles going on. Let's take a look at revenue and profit. Revenue and profit are both important financial metrics for business, but they represent different aspects of company's financial performance. And understanding the distinction between them is crucial for any business. Briefly, revenue definition. Revenue, also known as sales or turnover, is the total amount of money generated by business from its primary operations, such as selling product or services, over a specific period of time. It represents the income a company earns from its customers. Calculation. Revenue is calculated by multiplying the quantity of goods or services sold by their respective price. It does not take into account any cost or expenses. Purpose. Revenue is primarily a top-line financial metric that indicates companies' liabilities to generate sales or income. It provides insights into a company's market demand and its ability to attract customers. Now let's take a look at profit definition. Profit, also known as net income or earnings. It's the amount of money a company has left over after deducting all expenses, including the cost of goods sold, operating expenses, taxes, interest, and any other cost associated with running the business from its total revenue. Calculation. Profit is calculated as follows. Profit equals revenue minus expenses. There are different types of profit, including gross profit, revenue minus the cost of goods sold, and the net profit, revenue minus all expenses. Purpose. Profit is a both bottom line financial metric that reflects company's overall financial health and sustainability. It indicates where the company is operating effectively and generating positive returns after covering all of its costs. Just to summarize it, in summary, the key difference between revenue and profit is revenue is the total income generated from sales or services before deducting any expenses, while profit is the amount of money that remains after deducting all expenses from revenue. Revenue is a measure of company sales and income generated capacity, while profit refers to company's financial performance taking into account its cost structure. Revenue is typically the starting point of assessing a company's financial performance, while profit provides a more comprehensive view of profitability and sustainability. Both revenue and profit are important metrics for evaluating companies' financial performance, and they are often used together to assess a business overall health and success. A company can have high revenue but still incur significant expenses, resulting in low or negative profits. So it's essential to analyze both metrics in context. Thanks everyone for watching. I will see you in the next video.